Good morning, ladies and gentlemen. I've been asked to provide a presentation which focuses on two main points, namely what drives demand for mining and the outlook for the global economy, and how it will affect the mining industry. I wish to focus most of this presentation on the first point, namely what drives mining demand. This topic could be considered in two ways, namely why is there demand for mining, and what drives investment demand in mining. The answer to the former question could be summed up in one phrase. What drives demand for mining? Economic growth. Economic growth places an elevated demand for natural resources and by extension places a demand for mining projects. As a presentation around this topic would indeed be very short, and I'm sure the conveners did not intend for such a ludicrous result. In addition, I quite like to give presentations, so I've rather elected to focus on the question of what drives investment demand for mining projects from the investor's perspective. Additionally, as this is a junior mining conference and junior miners often require investment to progress through the relevant phases of development, I believe that this is a far more relevant angle. Specifically, I want to look at specific factors which are pertinent to investors when deciding to invest in a mining project. Whilst discussing these factors, I will make reference mainly to African mining projects in order to illustrate how Africa holds up with respect to these investment considerations. In the second part of this presentation, I'll provide some of our predictions for the outlook of African mining projects. With respect to junior mining projects in particular, it is important to realize that around 5% of junior mining projects are responsible for delivering over 90% of returns to investors. Therefore, whilst the returns may be spectacular, which is what drives investment demand in the first place, we need to be sensitive to the fact that the risk to investors for junior mining projects are particularly vast. Therefore, investors generally look at a number of key criteria or red flags before making their investment decisions. We consider the factors in order of importance. The first factor I'd like to discuss is management. The quality and experience of a mining firm is critical in the decision of an investor's due diligence process and is often the determining factor. The people running the country must be professionally competent and should have an established track record of past success. They must also be committed in terms of having a significant stake in the firm's equity. A company funded by 100% debt without the management taking a stake is often a red flag to investors. Performance-based salaries is also critical. Convertible share options held by management which stand to significantly dilute shareholder value is another aspect which investors consider. Above all else, management must know what they are looking for. A simple concept to state and a clear vision. The problem with junior miners, especially those which may have multi-resource deposits, is that they lack a clear vision about the type of deposit and its true potential profitability. I can't tell you how often I am asked whether a company should regard themselves as a rare earth prospector with some phosphate or a phosphate prospector which can potentially produce rare earths as well. And often the reason comes down to but which is more attractive and in vogue to an investor. Management must also be ruthless, especially when it comes to bailing out of a project that is not proving its worth. Many junior mining companies where the management is simply one where management is looking to hold out on the hope of a buyout offer. In this case, they are trying to play the greater fool theory. They know that there isn't much chance that the next drill hole will produce much, but they are unwilling to cut their losses and are therefore waiting for some greater fool to buy them out. So what investors look for is consistent and increasing positive news. For example, an initial resource statement followed by a revision of resources showing higher resource potential, or initial cost estimates in the pre-feasibility study followed by similar cost estimates in the feasibility study. What I've started to come across recently with rare earth producers in particular is in order to get that initial funding, the economic impact assessments, cost estimates, and we know that EIAs are not as accurate as feasibility studies, but even with that considered, those cost estimates are often a factor of 10 lower than what is finally produced in the feasibility study, and this creates a very negative outlook from the perspective of the investor. Finally, an investor would like to see other successful mining ventures brought to market by the specific management team. Suffice to say that it is easy for a junior mining project to get financed if the management team have in their time brought out other projects which are now successful entities. The second point I'd like to discuss are country and political risks. As commodity prices rise, two things happen. Firstly, producers and prospectors become willing to seek out more risky projects, and host countries of these resources become more greedy and possessive over their fortunes. Commodities are seen as a meal ticket in a way in which countries can raise additional funds. Therefore, country risks have increased considerably over the last 5 years, driven by higher global financial crisis, as governments see commodities as a way to make money. And this trend we expect will continue. Already several countries have written into their laws language that gives them the authority to nationalize or partially nationalize mining projects. For example, in Russia, the Russian Mining Code states that it could nationalize every mine of strategic importance, but does not define what constitutes a strategically important mine or commodity. In South Africa, the subject of mine nationalization has been brought up in countless times, but the government has never formally dismissed or denounced the notion. There are, however, some emerging economies where the country risk is actually relatively low, such as Serbia and Bulgaria. The war ended in Serbia around 16 years ago, and since the country has become open for foreign investment and has a favorable tax rate. It is also a potential candidate to join the EU, and as such, political risk has declined dramatically. In other instances, the perceived country risks are much higher than they actually are. One example is Eritrea. Despite the fact the government takes a relatively large stake in projects, a 10% stake with the option of raising this to a 30% if the NPV is high enough, and Botswana incidentally has a very similar system, there has not been issues of mine nationalization or loss of licenses, as is the case in the DRC. In Argentina, owing to the nationalization of the oil company, a lot of investors believe that mine nationalization would follow, and so the country risk premium is perceived to be much higher. However, this was already 15 months ago when the nationalization of the oil companies happened, and the risk of nationalization and the federal government involvement is limited as mining licenses are distributed by the states. Still, the perception is that Argentina is a much riskier country than it probably is. And with respect to South Africa, the perceived investment risk has increased dramatically since 2008, following strikes and wage hikes. On top of that, the BEE regulation, that's the Black Economic Empowerment Regulation, stipulates that 24% of every mining project is to be given to a Black Economic Empowerment movement. This legislation was supposed to be phased out in 2010, but to date it remains in the minds of foreign investors, and they believe it will increase to over 50%, as is the case in Zimbabwe. Whilst this is outside of the mining industry, I would mention that BMW is decreasing its manufacturing capabilities in South Africa by 50%, owing to high labour costs and unrest pertaining to labour. So stability, both political and social, is vital to attract and retain foreign investment. The next important factor which investors consider is location, location, location. And this cartoon illustrates the point quite well. For those of you at the back who can't read it, there's two miners standing on an island, and the investor says to the miner, "Why don't you rather find some iron ore where there are more workers?" And there are only 4 workers on this island. This project location must be considered from several vantages when investing in a junior mining or startup company. And these factors are the mining district and the project's proximity to other producing mines, the availability of infrastructure such as road, electricity, water and a labour force, the regional as well as the intraclaim geology and geochemistry. The geology of a junior mining project can be evaluated in several ways, but one of the most helpful tools when investing in junior mining companies is the Canadian National Instrument, or the 43101 report, and this is a mineral resource classification standard that is used for public disclosure of information relating to mineral properties. It's widely used throughout North America and in other regions, and the report complies with strict guidelines on how mining companies can disclose scientific and technical information about a mineral project. Reports which comply with the Australian JORC standards, which is the equivalent of the 43101, or the South African SAMREC codes, are also ways which provide investors with assurance and comfort. Another way to evaluate the geology of mining projects when investing in junior mining companies is by proximity to other proven or operating mines. There are mining locals or geological trends where multiple mines are located. Finding a junior mining operation in the middle of a prolific gold mining or silver mining area helps validate the possibility of a successful junior mine and large investment returns. In 2006, there was suddenly an increased number of junior platinum or coal producers being listed on the JSE and Altex markets. In addition to the usual metrics of evaluating junior mining companies, mining rights, management, resource quality, one of the considerations was proximity to an established platinum or coal producer that had not yet met their BEE quota, and therefore a BEE deal was imminent. The rationale in this instance was in order to secure the required BE credentials or points, it would be beneficial if an established miner such as Anglo's, Lonmin, Billiton would simply annex the junior mining company, and in that way the risk that the project would not have funding to go all the way was greatly reduced. Furthermore, the considerations over power infrastructure and management ability was also alleviated, as the area had already proven that it had existing infrastructure. Established infrastructure is another key element when investing in a junior mining company. Access to roads, utilities, water, labour, equipment can make a significant difference to the cost of the iron ore mined and the cash generated by the project. If a mining firm has to pioneer all or many of these infrastructural necessities, then it will need a higher grade ore to become competitive with a mining project that has all of this in place already. In June of this year, the Ring of Fire chromite deposit, which was located in northern Ontario, made the decision not to proceed with its EIA report and had to halt all work on the project. Despite a large resource deposit, a favourable location in terms of mining law, the fact that it would require large capital investment in order to secure power to the area due to its extremely remote location and delays with land right issues was a secondary consideration. This led to the decision to stop progression of the project. If we consider the 4 iron ore projects in Sierra Leone currently, the Kukuna Marumpa project, which is owned by Cape Lambert, the Tonkalili projects, which is owned by African Minerals, and London Mining's Marumpa project, and you can see the table which details the relevant attributes of each project. The London Mining's Marumpa project is the only project that does not have access to any or part of the infrastructure network, despite the fact that the rail line from Tonkalili to Papel runs directly past the Marumpa mine site. Cape Lambert has the right to 2 million tonnes on African Mineral networks, while African Minerals is ramping up its Phase 1. And thereafter, the project will have 5 million tonne allocation once African Minerals Phase 2 is commissioned. Access to infrastructure, particularly in Africa, is key. It enables a company to achieve growth and scale. London Mining's lack of infrastructure access could constrain its growth in the future and could limit the Marampa's project ability to ramp up to its desired 17 million tonnes per annum. Both of these examples of the South African junior platinum and coal companies, as well as the iron ore deposits in Sierra Leone, points to another important consideration for investors, that of scalability. Investors want to see growth potential in its projects. Companies with the ability to develop large and diversified resources or can expand due to resource size or proximity to transport generally fare much better in attracting investors. The fourth factor is predictability, and we've alluded to this already. But in the context of mining company evaluation, predictability refers to the stability and regulatory consistency of the political jurisdiction in which a company operates. Junior mining firms are finding it increasingly to their advantage to operate in regions that have predictable regulatory frameworks around mining operations. When investing in a junior mining company, one resource is to look at the Fraser Institute of Canada's annual rankings of the top 10 most friendly jurisdictions in the world. In 2013, the least attractive jurisdictions were as follows, but the DRC was rated the best out of the worst bunch: Indonesia, Vietnam, Venezuela, DRC, Kyrgyzstan, Zimbabwe, Bolivia, Guatemala, the Philippines, and Greece. All of these countries were in the bottom 10 last year, with the exception of the DRC, Greece, and Zimbabwe. Both the DRC and Zimbabwe dropped significantly in the rankings over the last year, falling from 76th to 93rd place in the case of the DRC, and it is only out of 100, and from the 74th to the 91st case in the case of Zimbabwe. On average, Africa's score as a whole has declined, continuing its 5-year declining trend. Mali dropped the most, followed by Madagascar. Mauritania and Namibia showed improvement, while Botswana remained the highest-ranked jurisdiction on the continent in 17th place. And as a result, Botswana does realize foreign investment in its mines, and outside of diamonds, there is presently discussions around investment in a fertilizer industry, various copper and coal prospects, as well as a power line. The bane of a mining company's worldwide has been is to incur the substantial cost of finding, developing, initiating production on a rich ore zone in less than a stable political jurisdiction, and then just when the project is generating significant cash flow, having it either confiscated or made uneconomical because of arbitrary increases by states in royalties, rent seekings, or other mineral-related payments. One recent example, which was cited by the Caesar Gold report, which just illustrates this kind of state arbitrary action that occurred in August 2011, was when Hugo Chavez decided to recall the country's gold reserves and nationalize the gold mining industry. Speaking on state television via telephone, this leftist leader indicated that he would introduce a new decree in the coming days to put exploration and extraction of gold into the government's hands. Closer to home, in August this year, Zimbabwe's president made a bid to seize control of 51% of foreign-owned mines without paying them, as part of a program to accumulate the $7 billion worth of assets following the July election victory. Non-compliant mine owners would risk losing their licenses. KPMG also assessed the political risks and operating environments of African mining jurisdictions. On this graph, we note that Algeria, Ethiopia, Swaziland, and Zimbabwe rank as the worst from both an operating environment perspective, which is shown on the x-axis, as well as in terms of political risk, which is detailed on the y-axis. Whilst Botswana and Zambia are regarded as the best countries to operate in from both a political risk perspective as well as the operating environment. And the last important factor which investors consider is the deployment of capital. Has most of the money gone into general administrative expenses and into investor relations expenses, indicating that the management is more interested in its share price than in mining? This often goes hand in hand where management is remunerated with share options, as opposed to aligning the remuneration package with performance and milestones and earnings, which we discussed earlier. Or has most of the money gone into drilling, assaying, testing, ore body evaluation, the preparation of corresponding reports? If it is the former, it must be regarded as a red flag to investors that management is more focused on promotion than production. If the firm has completed an NI 43-101 statement, or is JORC compliant or SAMREC code compliant, and it has completed a preliminary economic assessment, or even better, a pre-feasibility study or feasibility study that includes a definitive resource calculation, and some estimates of a project's economics, then this is an excellent sign that management has spent its capital wisely and is actually looking to build shareholder value through the development and exploitation of its mineral resource. The other thing that an investor needs to consider when investing in a junior mining company is the level of the firm's debt. Long-term debt in the form of convertible debentures can be a quick way to go bankrupt if the firm has no immediate cash flows, which it won't have if it doesn't have other producing assets and is still in the development stage. Frequently, these debenture holders want to drive the share price down so that they can convert into greater amounts of equity, and this can send the company's shares into what we call a death spiral. This set of circumstances is a common outcome among the juniors that are constantly cash-strapped. Most juniors an investor will encounter are not in a strong cash position, which represents opportunity when investing in junior mining companies. Investors need to determine if the firm has enough cash on hand to sustain minimal levels of operating when investing in junior companies. This leads us back to our first point, that a strong and experienced management team is critical to the success of a project. What we say is that a good management team can often make do with a mediocre ore body, whilst history will show that a bad management team could take the highest quality ore body and they won't be able to make a go of it. For the last part of this presentation, I want to look at our outlook for African mining projects. Since the early 1800s, Africa has channeled investment into mining infrastructure and has been responsible for satisfying the world's commodity requirements. However, by the early 1990s, only 5% of global exploration expenditure was channeled into Africa. The main drawbacks to investors being infrastructure access to foreign exchange and stable legal and political frameworks. However, from 2012, 15% of all global exploration expenditure was in Africa, led by Chinese demand. With respect to mining opportunities, East Africa has several commodity belts that include gold and precious metals. Burundi boasts copper, cobalt, nickel, and uranium, while Central and West Africa is known for its iron ore potential. West Africa exported around $150 billion worth of goods and commodities during 2011. But the country-specific political risk still plagues most of the continent. North Africa is host to around 85% of the world's phosphate reserves, which is gaining increased importance as a raw material feedstock for phosphate-based fertilizers. As populous nations expand, such as India and China, and they continue to urbanize, so wealth increases, so diets change, placing increased demands for fertilizer and foods. Also, as urbanization expands, the amount of arable land declines, and increasing crop yields through effective fertilization becomes critical. China accounts for around 17% of the world's mineral imports by value in 2012, and 16% of Africa's exported commodities, were shipped to China, which amounted to over $100 billion in 2012 across 23 African countries. Going forward, 6 mining destinations have been identified as growth jurisdictions with respect to mining investments. These are Botswana, Ghana, Mozambique, Namibia, Tanzania, and Zambia. Botswana is the largest diamond mining area in the world and has proven reserves of copper and coal, the development of which has been identified by government as a priority. There is also a high-level discussions of a power line in Botswana to supply the mines, which will ultimately be fed by indigenous coal sources. Ghana's gold is the most important sector in the country. The mining landscape is dominated by foreign firms, and Ghana's gold reserves is the second largest in Africa after South Africa. In 2011-2012, over $20 billion was invested into the development of the gold sector in Ghana. Mozambique's coal production potential is estimated to reach 100 million tons within the next 5 years, and it is expected that by 2016, mining will contribute around 18% of the total value add to the economy. Like South Africa, Namibia has a variety of minerals available in economic quantities and is the fourth largest exporter of non-fuel-based minerals in Africa. The mining sector is expected to expand by 17% per annum until 2017. Tanzania is relatively small compared to the other mining jurisdictions, but around 90% of the known mineral reserves remain unexploited. Next year it is expected to realize the development of its uranium sector with the Makuji River project. Zambia has a wide spectrum of base metal resources as well as gold and manganese. The country is heavily dependent on revenues generated by copper and cobalt exports, which account for 10% of the country's GDP and 80% of its exports. The sector is expected to expand by around 3.5% over the next 4 to 5 years. Overall, our outlook for Africa's mining industry as a whole remains positive, driven by the continuous growth and urbanization of populous economies. The main risk to Africa is the lack of infrastructure and resource nationalism, which will be brought about by political and legal instability, which will continue to deter investors. However, there are still projects happening, not just in the countries which we mentioned, but also in Mauritania, Cameroon, DRC, Kenya, Rwanda, Sierra Leone, and many others. And we still regard Africa as a continent that presents vast opportunities with respect to mineral extraction. Thank you.